Hello, hello. Hi, good evening, everyone. Can you all see my screens and hear my voice? So we'll wait for another, I think, 3 minutes. Then I will start my sharing sessions. So who is new in this option trading? So today I will be talking about the buy option trading. So for those who don't understand what is option trading, I will try to explain it in the easier way for you all to understand. So because option trading is not that easy and you need some idea on idea on how to trade. So I hope you all can share with your friends like about these free sessions. I hope I can share more about the basics for you all to easier to like uh, very easy to learn these options. Yeah. Yeah. So here. All right. So I think today there is not much people here. So if you all can just try to share with your friends. Every week we use Smart will share this class sharing sessions about options and about trading. So I hope you all can attend more if you all are new in trading. And thanks for the support at today. All right. So okay. All right. I think it's almost time. Let us get started. I will start by introducing myself. My name is Ming. So I've been a full-time trader for past 7 years. I trade forex. I invest in stocks. I also trade stocks also sometimes, and I also trade and invest in cryptocurrency. I do use automated trading bots to get a fairly consistent profits through the market in any kind of trend, like using grid trading. So you all can also follow me. Like every month, there will be a grid trading, automated trading strategies sharing sessions in UseMart. So so make sure you all follow our this sharing webinar closely, and all is free. So do hope UseMart users can benefit from these sharing sessions. I might not dare to say I'm a guru, and I'm still in trading world and investing world. We are always learning. So let us like learn together. All right. So today we'll be talking about option trading. So let us start with the easiest uh, option trading basic, which is the buy side of the option trading. So in this sharing sessions, you all will discover how easy the options can be. So first of all, this is disclaimer. So for any examples that I shared, it's just mainly for education purpose only. All right. So what is options? Options are contracts that give you the rights to buy, but not the obligations to buy or sell an asset at a specific price before a certain date. So there's some keywords. It's like this is a contract and you have the right to buy or sell. To buy or sell an asset like stocks at a specific price before a certain date, expiry date. So you all might get very confused in the beginning. So don't worry, this is just a definitions of options. So I will let us dive more into the understanding. I will explain it by using the daily life examples. So this is roughly the definitions of options. It gives you the right to buy or sell. So I will be explain the options by using car buying examples in life. So there is two types of buy options, which is buy call options, and another one is buy put options. In this case, I will start off with call options, buy call options. What's buy call options? So please be patient with me. Let me explain it in using these examples. So imagine if you want to buy a car, right? Like this Lambo. So you might think that you want to wait it and um, you you think that the cars might going up in futures, but you want to wait it, right? So you talk with a car seller, then you all make a deal. So you tell the boss, so I will give you a 500 deposits to buy this Lambo at 20,000 after 3 months. Deal or not? And then the car buyers will think that, oh, okay, it won't goes up, and this it won't goes up over 20,000. So this 500 deposit will be mine. So the seller will agree with this contract, and a contract is done. So you all deal with this. Your a contract is dealt. So the you give the 500 deposits to the seller to buy this Lambo at 20,000 after 3 months. Then the car dealer will say, okay, I will accept your 500 deposits and I will sell to you at 20,000 after 3 months. So you pay them the $500, a small amount compared to the car price, to give you the right, but not the obligations, to buy the car for 20,000 anytime within the next 3 months. You are paying the 500 deposits to book the car, to ask the seller to sell to you at 20,000 after 3 months. So you just put a deposit. You just imagine that you pay these 500 as a deposit to buy the car at 20,000 after 3 months. So this is like buying call options. All right. So this is how it looks like. So you as a buyer, you pay $500, and the car sellers will receive this $500. Then you have the right to buy the car at the car seller agreed price, which is 20,000 after 3 months. And the car sellers is obligated to sell the car to us as a car buyer at an agreed price $20,000. So there's a few scenario in this case. So good scenario for us as a buyer if the car goes up to 25,000. So since we are buying call options, there are two types of options, which is one is call options when you are looking the price to goes up. Another one is put options when you are looking the price to goes down and you want to profit when the price goes down. For the scenario in call options, you want the price to goes up and you profit from them. All right. So if the good scenario is if the car price goes up to 25,000, great, because you have the right to buy at 20,000. Imagine now you make a deal with the car seller, and the deal is after 3 months, the car seller have to sell to you. You can buy the car with 20,000 from the car seller. All right. So now the car is 25,000 after 3 months. So you can buy back at 20,000. The current market price is 25,000, but you can buy back at 20,000 from the car seller. So it means that you earn 5,000, right? If the price goes up after 3 months, then it deducted by the $500 deposits you gave to the car seller. You earn you earn 4,500 in total. All right, because when the car goes up to 25,000, you get to buy the car at 20,000. And bad scenario for us, if the car fall below this 20,000, what will happen? Remember that the options give you the rights to buy. In this call option scenario, it gives you the rights to buy. So what is what is the right to buy? The right to buy it means that you can decide to buy or not. All right. So if the car fall below is break evens or fall below 20,000, you won't buy the car, right? You can decide you don't have to buy it because and then you just lose maximum $500 only. All right. So like call options, you just have a minimum like risk, which is the premium you paid. This 500 is the deposit. The deposit is the premium in this option case. So if the price went up, you can buy back at 20,000. If the price went down below 20,000, you can choose to lose only this $500 and you don't have to spend any money to buy the car. Because since it fall below 20,000, right? Like 15,000, you can directly buy the car at the market price, which is 15,000. One wouldn't be so stupid to buy if the current market price is 15,000. They won't buy at 20,000, right, from the seller. We just directly give up the deposits 500, and then you just lose the deposit, and then you don't buy the car from the seller, which is at a agreed price, which is 20,000. So if you all have any questions, please don't hesitate to leave down in the chat box. I hope my explanations can deliver to you all, and I hope these examples can let you all have a better understanding about what is called buying call options. All right. So at the same time, what is the bad scenario for the seller? If the price goes up to 25,000, let's say it goes up, we are earning, right? We are earning, and then the seller is obliged to sell. When we decide to when we decide to buy the car, the seller is obligated to sell the car. So even though the seller received this 500 deposits, he still lose 4,500 overall. All right. So the maximum, the seller will be receive this $500, but if the price goes the other way, he lose a lot of money because now the current car price is 35,000, but he has to sell to us as a car buyer at 20,000. So he lose $5,000 and he received this 500 deposit previously. So total he net loss is 4,500. However, the good scenario for the seller will be if the car price stays 20,000 or fall below, we as the car buyer, we won't exercise these options because we can buy the car at a cheaper price outside the market. So we decided to give up the deposits and the car sellers will earn the deposits. All right. So this is the relationship between the car buyer and also car seller, which is also the option buyer and also the option seller in this call options. Option buy call and sell call. So this is the relationship between this. So for the put option is the other side, the opposite side. So here we don't explain that much. We just focus on the getting hang of the idea of the call options. So let's recap. So in this case, there's two people exist in this contract, which is you as a buyer uh, and the seller as a car seller. So if we as a buyer in call, we call buy call. We are the call buyer, and then for the car seller will be the call seller. All right. So you want to buy the cars above to 20,000, and you as a buyer, you hope the car to goes up, and then the car sellers wanted to earn the deposits. So you want the car price to stay even or go below 20,000. So we as a buyer won't exercise to buy below won't exercise the price, and then maximum of us will earn as a seller will earn the deposits only. And then the maximum risk of the buyer, call buyer, will be only spend the $500 only. Like you just lose the deposits, maximum one. All right. So let us go back this to call options. So we as a buyer, we pays the in option trading. We as a buyer, we always pay premium, which is just now explained, is a deposit 500 premiums to the car seller. A car seller will be the call seller, sell call. We call it sell call, buy call and sell call. So we are buyer, we buy the call options. So if you become the seller role, you are selling the call. So the buyer of the options, the buy call options, he paid the premium to the seller, sell call. All right. So buyer paid 500 premium, and then the seller will receive $500. And then you have the right to buy, the buyer have the right to buy the car from the car sellers at agreed price, which is 20,000. So this agreed price 20,000 is called strike price in option trading. And to whether to buy back or not at 20,000 strike price from seller anytime within 3 months. In this case, within 3 months is the expiry date in call options. And when you want to exercise the options, the car sellers is obliged to sell the car to the car buyer at agreed price, which is 20,000. He agreed to let you buy back at 20,000 anytime within these 3 months, which is expiry dates in call options. All right, so this is the idea of the call options. So you want to buy the car at 20,000. So you want to buy the car at 20,000. You pay $500, which is premium to the seller, and then the maximum you lost is, if it goes down, the maximum you lost is $500, and the maximum profit of the car seller will be this 500. All right. So you as the buyer has the right, if you are looking for long, you want to earn when the price goes up. So you have the right to buy the car at the car seller at the agreed price at 20,000. You hope the car goes up to earn, while the car sellers hope the car price to goes down, so that he can earn the deposits. All right. So you have the ideas on how this idea this this is the idea behind this option trading. All right. So next we'll be dive more into what is strike price, expiration date, and premium. Just now is roughly the idea on how we earn the buy call, how we earn via buy call options. So usually when we look at the options, we will look at this. There is GLD. GLD is a gold ETF. This is a simple thing we need to look at. And then there's a expiry date. In this case, it's 17 January. and then there is a strike price. In this case, it's 244, and another one will be type of the call warrant. In this case, will be the call warrant. C will be the call warrant, and P will be the put warrant. Put warrant is when the price goes down, you profit, and then call warrant is when you are bullish, you want to earn when the price goes up. All right. So we just focus on the buy option first. We don't care about the sell call. We now all we talk about is buy call. So just now I said that when we exercise the price, we can buy back at the strike price, right? Like buy back the car at the 20,000. But in the real scenario, when we trade option trading, usually most of the trader, they won't exercise the options. Why? Because the price can fluctuate. You today, like just now, like I say, the car scenario, if the price went up, if the price goes up, sorry. So if the price goes up, you have to like you want to exercise the options trade, right? You have to take extra money to buy the options at 20,000, the car at 20,000. That usually people just try to trade the price difference, because like if there is 3 months of expiry and then you hit the certain profits in like maybe 1 month or 1 week, we don't know what will happen after 3 months, right? It might fall down and then fall back, and then you just lose. So for option trading, I don't recommend you all to hold until you need to exercise, because there is many uncertainties. You have to wait until like 3 months. After 3 months, you only can exercise the options. So we better like trade the premium, because the premium, when you hit the target, the premium will goes up and then you can earn from it. So let us dive into more examples on how option works, how we trade the options. So just like I explained, why most of the traders won't trade, won't exercise options. It is because the capitals you needed is a lot bigger. What options contract equals to 100 shares? Let's say like you buy apples, like now is maybe $300. You need to prepare, the strike price is 300. If you want to exercise the $300 options, you have to pay 30,000. You have to pay 30,000. You have to take the extra 30,000 to buy the share at $300, 100 shares. So some people just, because initially we trade options, we just pay the premium, However, if you want to exercise the options, you need to buy at the strike price, 100 shares of the strike price. So many people, they don't have like 30,000. People won't wait until exercise, because you have to wait the expiry dates hit. There's a lot of uncertainty there, because the price can goes up in first weeks and then drops all the way down until the expiry date. So people just trade the premium only. All right, I will. Second, and it's complicated. We have to wait too many uncertainties if we wait until the expiry date to hit. So most of the traders, they trade the options gains from the difference in premium. Let us give some examples. So in this case, this is GLD, which is a gold ETF, and then the expiry date will be the 25th of of January, and then the strike price will be 244. Then this will be the call warrant. We want to profit from the market price, the stock market price goes up. So this is a strike price. So if the price goes above, so we can, so how do we trade this option trading? So in this case, the strike price is 244. So we can use our Usmart apps. Then we press in. All right. So usually you press in, then you choose the option trading. And then in this case, here is option trading. Sorry, it is in Chinese. Never mind. You find the option trading. Uh, you find the option trading words tab there. Then first of all, we look at the strike price. We choose a expiry date. And in this case, the expiry dates will be the 17th of January, which is 30 days expiry. Then the strike price will be 244. Then you can see that the price of the premium in this case is 4.441. Okay, I think there's some error. The premium will be 4.41. Never mind. We just follow this case, which is 4.42. Usually the 100 shares, the premium one contract of option trading will be 100 shares. So the premium you need to pay actually is 4.42 times 100, which is $442. So in this case, the maximum risk you afford to lose is 442. So let us compare options with share. So there's a leverage in options compared to share. Let me give some examples. Like when the price now, the strike price, the GLD price move from 244 to 250. When you buy a normal stocks, usually the gains will be only 2.46%. However, if you use options, you can check the effective gearing. So in this case, you can see the 244 strike price, the effective gearing is 54.51. All right. So basically from the premium is 4.42 because the leverage is 54 point because the no this in this case the leverage is 27.65. So you can see that there is a leverage of 27.65x here. So if you buy the options using this if you buy the GLD using these options, if you buy the shares, the gain is 2.46% from 244 to 250, right? And if you buy these options, the gain is 67.99% because there is a 27.65x leverage. So this is the power of the options. And then the maximum you lose is fixed. No matter the price goes up, goes down a lot, the maximum you lost will be only the premium you pay. So let us compare another one with option vs future tolerance. Then the future, I'm not sure you all know what is future. Future actually is like a leverage tools also. You have to put your stop loss. Like let's say when the price you use 5x leverage, when the price drop by 20%, you are total loss 100%. So we compare options, same leverage. There is leverage between these futures and also options. So if you trade futures, you have to put stop loss, right? If not, they easily you easily get margin call. So in futures, if you use futures, sometimes the price hit your stop loss and then goes up to your directions, right? Because futures require a greater accuracies and lower tolerance. However, if you buy these options, you have the high probability of profit as long as it's staying above the strike price. Let's say it's dropped first. It drops first, then it goes up. So in the future case, it already hit your stop loss. You don't have any positions. However, if you trade options, if it hit your if you hit a certain below this strike price, and then you went above strike price, you still can end up in profits. So in this case, compare these options, share, and futures, you actually have a leverage and tolerance, better tolerance in options, while share don't have leverage and futures don't have tolerance. So this is what makes the options a better trading tools, leverage tools in this investing world. So call vs put. Actually, put is the opposites of the call options. So basically, it drops, and then you earn the money, and then the seller will earn the deposits. Is the same. The seller will earn the deposits when the price goes up. You pay the premium and hope that the price goes down. The profit from the dollar. So here we don't explain that much because we have a limited times. So yeah. So until here, who have any questions you all don't understand about this, or want me to explain more? If you all don't have any questions, I will just continue. So how actually like pick a good stock options? Usually, I would recommend to trade a bigger market cap stocks like maybe Tesla, Nvidia, those Apple, Amazons, those famous one. And then you look at the trading volume, must be very active. And then you have a basic direction bias, like is the stock is on uptrend or the stock is on downtrend. It depends on you, but it's suggested that I suggested that you all look at the better uh, bigger direction bias, like is long-term uptrends or long-term downtrends, but not look at a very short time frame directions. Then you have to determine the share price range that is always ranging or is on uptrends. The high become higher and the low become lower or not. And then how we choose a good options. So we usually choose a expiration date with 1 to 2 months, or maybe 3 months is okay. But we don't choose less than 1 month because that's actually a time decay, which is very a more advanced knowledge. But today we just share a basic one. You try to choose more than 1 month options. Then we have to look at the volume, make sure that the contracts, the option contracts, there's a volume in the option contract, which is more than 100 contracts. And then the open interest is very high. That's a lot of people is trading these stocks. And then we look at the strike price, like let's say the price now is 200. We try to buy a very near strike price, like which is maybe 190 or 210. It depends on how greater leverage you want to choose. You have to look at the leverage. Then we will need to look at the IV and the volatility of the options. So this is actually just a guideline. For the IV, we just want to choose less than 0.5. 0.5, yeah. But this is more advanced stuff. Today we just share about the basics of the call option. Then if anything in futures, we all will deliver more advanced classes. And then we put the limit orders or market orders to buy the options. So I will share what option trading is today. So mainly I let us make a recap. So call options is a right for let you to buy at a specific price, at a strike price from a seller, then with a expiry date. So we usually for newbie, for starters in option, many people will feel very confused, right? But I would suggest you all maybe can try to start a little bit, because sometimes you need to start, then only you learn. Yeah, there's this idea on how you trade. You have to get into it, get started, only you can earn, right? So So yeah, so we start first and then we keep on refine our trading strategies. If anything, you all maybe can try to contact us or maybe ask in the public groups of Usmart. I believe that there's a lot of people will try to answer you all in the community. And then if any you all have any questions, you all can look into the apps and then choose the top right bottoms, and then you choose you can find your specific managers to contact with. All right. So yeah, so there's the Telegram groups, and for those who want to add me, and if you all have WeChat, can consider to add my WeCom, or we all just build a Telegram groups, which is a fairly new one. I think nobody inside. So if you are, if there is more people enter these Telegram groups, so we all can maybe share more in future, share more knowledge in futures. So I do hope you all learn something today. So options, this is option trading. So let's go back a little bit. Yeah. So what is call options? This today recap that usually we paid premium to the seller. So we as a buy call options. When we buy call options, we paid the premium. And then the premium, then we look at the strike price. That in this case, you agree the car sell it to you at 20,000, and we are obligated to sell the car to the car buyer at agreed price at 20,000. So if the car goes up, you earn the money, but you earn like when the car goes up to 25,000, you can buy back at 20,000. Then you earn this 5,000, then deducted by the $500 $500 premium, then total you made 4,500. This is the idea of the call options. So if you all have HV actually is a volatility. But I think that the one is not that important stuff. Usually we just look at the IV. All right. We just look at the implied volatility. So usually we don't look that much because there's a lot of there's also some maybe delta, those Greek value, but for those starter, I think we just look at the simple one: implied volatility, the open interest, the volume, the strike price, and we choose the big cap stocks to trade. All right, to have because big cap stock have more liquidity. Okay, can I explain on how to earn from a difference premium? Oh, all right. So when now, let's say, okay, let's say good back. Okay, let's say we buy this GLD at 244. All right, the premium, let's say is 4.42. All right. So when the price move up, so it's in the money, right? Because we earn the probability of the options in above the strike price, the probability you end up above this strike price is you end up profits is higher, right? So along the way, if the price goes up, the premium, let's say you buy the premium is now 4.42. However, if the price continue to goes up, it can go, the premium can become more expensive because the probability of the price at the strike price you when you exercise to profits is higher, right? So along the way, the premium will get expensive. Let's say it's when the price goes up from 244 to 250, the premium with the leverage, the premium can go from 4.42 to let's say $10. Then you can directly sell you bought at 4.42, then you can directly sell at 10 when the price of the price move up. So this is how we earn the premium. We don't have to exercise the options. We just trade the premium difference. So when the price goes up, the exact contract premium will also goes up, because the probability of you to earn when you exercise the share price, the options is higher. So the premium is getting expensive when it move far away above the strike price. So I hope I explained this to you. This is how we made this is how we trade the options. We trade the difference in premium. So you just imagine that when the price goes up, you will earn your money, your premium will goes up too. So when the price drops, your premium will drops too. This just like trading a normal stock price, but with leverage. You just think like this way. When you sell, that's why we want to choose those with have enough liquidity. It's like buying the stocks, right? There's always a people's like you can sell to. When you buy and sell, there's always a people you can sell to, right? This you just think that it's like normal share trading, but options is just you just treat these options like when you trade this premium, you just treat it like a normal share trading, but the leverage is much more higher. That's all. All right. Oh, I hope I explain. I hope you all understand what I'm saying. When you sell in an option, yes, when you become a seller, actually there will be a class next week as a sell side, but I will explain it here. So when we become an option seller, so when we sell this option, let's say we sell call, we will directly earn the premium. We will directly earn the premium because we get the deposits. However, if the price goes wrong, we will suffer a lot of wrong direction. Will suffer a lot of losses. So stay tuned with me next week, because there will be a option sellers strategies, and then option seller actually is much more profitable, and many people's is a very famous trading strategies used by Warren Buffett. Warren Buffett earned a lot by becoming a sell side option trader. Yes, so option seller mainly we want to earn the deposit, earn the premium only. This is the maximum we can get. All right. I hope I answered your questions, Richard. So just do a recap. You just we as a option traders we trade the premium difference only. We look at this price, we buy it at this time, and then when it move up, we just pick a good leverage options. Then when it move up, the premium goes up, and then if you got profits, you just sell it. Yeah, that's it. Just like you do a normal trade, normal share trade, but this is just with leverage. All right. So every week, every month, actually there will be a repeating trading class. I will not say that it's class. It's a sharing sessions and about these options and also others trading method and trading ideas, and also the psychology or investing psychology mindsets behind. So please stay tuned with us. And if you all feel our sharing is good, feel free to share with your friends and family. Your support I'm very much appreciated. And thanks for coming this sharing sessions. I do hope you all can learn more. Yeah, I do learn something here. All right. If there is no questions, I think this almost time. I think we'll end these sessions today. So if you are, I think Telegrams there is I think only one people join us. So if you all are interested, so please join us more. Then we'll make the community alive. All right. So if there is no any other questions, so stay tuned with my next week sell side options. Become a seller in options. All right. Okay. So yeah, options you can only trade the options during the market opens. You can't trade any other times. You only trade when the market. You only can trade options during when the market opens. Okay. So is there any other questions? If no questions, I will call it a day. And thanks for the support. All right. So let us call it a day. And thanks for supporting my sharing sessions. I do hope to see you all next week. Bye. This disclaimer. All right. And bye. Okay, thanks for your support.